Part 3 in what seems to be a running series on what ifs. A little side note right up front. I am personally skeptical that we will see any significant notable rise in interest rates over the next 5 years. Anything more than 1 or 2% type thing, which, as per episode 220, a couple episodes ago, part 1 of, I guess, what is becoming at least a 3-part series as of today, demonstrates that it's really not going to be a challenge for borrowers to deal with a 3%, 4% interest rate at renewal, because, well, as we now all clearly understand, they were stress tested at 4.79 to 5.25. So they were already qualified above interest rates doubling from where they are today. And the other piece of this, too, is keep in mind it took a decade following the 2008 economic crisis for rates to even crack into the mid to high threes. So yes, of course, this time could be different. Although when the Bank of Canada had that small run back in 2017, 2018, where they increased prime a quarter point, like they increased the overnight lending rate to be specifically by a quarter point 5 times through that year and a half stretch or so, a lot of us were left thinking they'd gone at least 1 quarter point hike, if not 2, too far, too fast. And that was pretty clearly indicated on March 6th when there was an emergency cut of a half point. Like they'd been struggling to keep that rate where it was the whole way through 2019 into 2020. So it didn't take much. I mean, it was just, that was March 6th. I mean, that was well before the lockdown. That was just when they could kind of see what was coming, and they got out a little bit ahead of it with that emergency rate cut at the time. But then, of course, the overnight rate fell all the way down to 0.25%, which is where it remains today. Well, let's get down to it and answer, once again, my own inflammatory headlines question. What if interest rates quadruple? Well, what if indeed? Let's do some math and see. Does 4 times the rate mean 4 times the payment? No, it doesn't. Double the rate meant the payment increased by 20%. Triple the rate meant the payment increased by 40%. So again, note for these numbers, we're going to continue to use a 25-year amortization to reflect and capture the more conservative borrowers and the first-time home buyers putting less than 20% down, who are forced into a 25-year AM to begin with. So all these numbers are based initially on a 25-year amortization. So as of today, July 2021, if you were to borrow $100,000 at 2% over 25 years on a 5-year fixed mortgage, your payment is going to be $423. Let's just call it $425 a month per 100,000. Now, if rates have quadrupled at renewal time, well, you're renewing the balance at the end of the first 5-year term is $83,770. So we're actually renewing a balance of $83,770. It's an important detail when you're trying to calculate the impact of interest rate increases. So you've got a little bit lower balance at renewal, 4 times a 400% increase in the interest rates. So from 2% to 8%, if that's what had happened, and still maintaining a 20-year amortization at renewal, because that's how many years are now left, there would be options. The reason I specify that we're maintaining the amortization along its original timeline is because there is potentially the option to re-amortize and to extend the amortization out, which would bring the payment back down again and at least, take the edge off. But we're not going to take the edge off. We're not going to play any of those maneuvers or games. We're just going to keep it real, like the darkest possible picture. So the 83,770 ending balance is being renewed at 8% over 20 years to keep the amortization on track, back into a 5-year fix, because these folks, well, anyway, we'll set that aside. What is the payment? The payment is $693. Call it $695, round it to $700. $700 per month per 100,000. Now that is not a small increase by any stretch. Currently in Canada, average new mortgage balance, $400,000. Income to qualify, $80,000. That's about $5,000 cash in hand each month after taxes. So after our initial $1,700 payment, the borrower had $3,300 a month to cover, groceries and life. Through from now until 2026, when we have this hypothetical 8% hit. Now, if we're going to play this game and we're going to say that interest rates have in fact gone up 400% to 8% by 2026, then, acknowledging that's a little bit of a stretch, I think is important, but we've also got to assume a few other things. I mean, what drives interest rates up is an economy that's booming and inflation is running wild. And that probably means that people got raises. They probably did. I mean, the cost of goods, the cost of materials is increasing. The cost of labor is going to as well. So, again, it's usually like something like 2008, 2020, in the face of an economic crisis, in the face of spiking unemployment, rates are cut to rock bottom levels. They're not boosted during a period of economic devastation. So again, it's reasonable, I think, to allow me to use a 2% raise for our hypothetical borrowers in an 8% interest rate environment. And 2% doesn't bridge the gap all the way, but what does it do? So that would take the net cash in hand from $5,000 a month to $5,450 a month. And no, the $450 new money is not enough to offset the payment spike we're talking about. But just how bad is it? Well, our borrowers started out with $1,700 payments against $5,000 net cash in hand at the end of the month, leaving them $3,300. Let's hope they were saving some of that $3,300 a month for a rainy day, because at 8%, it's raining. It's raining. They now have a payment of $2,800. Yes, their payment has gone up by $1,100 a month. And most people, in the face of a question like, could you handle an $1,100 a month increase in your mortgage payment, will say, no way. They won't do any math. They won't look at their household budget. They won't think about anything. They will just say, no, we couldn't handle that. That's one of the problems with polls. But I digress. So once again, I'm going to highlight that for a household composed of one person, of which there are 4 million such households in Canada, the mortgage payments would clearly continue to be made, because a lone individual is still going to have $2,650 a month left over, right? The $2,800 payment taken from a $5,450 cash flow, net cash in hand, still leaves the individual with $2,650. I'm pretty sure a lone individual is going to be able to carry on month to month through that. So this would admittedly be putting a major squeeze on a household of 3, 4, or more, although it may still be doable, but there will certainly be no more dinners out at all. Now that right there, what I just said, no more dinners out. So it's actually like a little bit of a bigger euphemism. There wouldn't be a lot of spending on anything other than necessities, right? Groceries, gas, that's about it. There's not a lot else happening. There's not a lot of vacations. There's no new TVs, no new furniture, no new clothes. Things are tightening up big time. And that is really the key. So that's what I'm going to spend a little time on. This is the key. The concern that the federal government has is not about Canadians failing to make mortgage payments. The concern is about Canadians only making their mortgage payments. That's what drove the creation of the stress test, not concerns about foreclosure or real estate market implosion or shady, shifty borrowers with, unqualified income, et cetera. No, that's all a bunch of noise. That's a bunch of smoke. Previous regulators have touched on this in the past, including in some parliamentary testimony that we've seen, but it's never really been highlighted anywhere mainstream. I don't think it makes a good headline, so it hasn't been catchy enough. But there is this nugget of truth around the mortgage guidelines having been influenced by macroeconomic viewpoints and policy initiatives around keeping the gross domestic production numbers in line, as well as, very importantly, gross domestic consumption. Right? Retail spending. So there's a lot more to keeping an economy going than lots of us understand, certainly more than I understand. So while things may seem overly prudent in mortgage lending world, it may seem that we're, just stress testing the heck out of these applicants to be safe, to ensure stability in the real estate market, stability for lenders, et cetera. The real story is that the federal government, would prefer to see homeowners giving up on home ownership and taking their savings, their would-be down payment money, and spending it on things, buying stuff, as they say, buying things they don't really need to impress people they don't really care about. That's really what holds our economy together, right? And if the economy holds together, well, the country holds together. That's also how that works. So making mortgage payments, that doesn't stimulate the economy. In fact, it's just shy of sticking the money under your mattress. You're taking that money out of circulation. So again, that's a slice of what's kind of happening behind the scenes. But as we can see, even at a 4 times increase in interest rates, even going from 2% to 8%, we don't really have a full-blown crisis where tens of thousands of people decide to sell their homes, because again, there's other factors in the mix there. And we're setting aside all kinds of different things, like, do they have a basement suite in the property? And is there additional rental income coming in that wasn't used in the qualification? Is one of the people living in that house working part-time? Again, income that wasn't able to be used to contribute to the application. Better yet, are they working as a waiter or a waitress, a server, a bartender, where there's tips, there's a cash component, income again that wasn't used to qualify? This is the case in a lot of households, especially when you get into a bigger household. There are often other streams of income, documented, undocumented, etc. So look, I get it. People would love to talk about 1981 and 1982, but I think actually in the face of an interest rate spike where people start talking about 1981, 1982, what people are really going to start talking about at that point is 1983 and 1984. Because while rates shot up from about 10% to 21.46% very, very quickly, almost in a straight line, they came down very, very quickly, almost in a straight line. So we would weather that storm somehow. The very best way, I mean, I can't not put a plug in for my fellow mortgage brokers. The very best way you're going to navigate any kind of interest rate increase or anticipation of is by having detailed conversations with an expert broker who can talk about an array of options. There are still Canadians out there who think that the 5-year fixed mortgage is the only mortgage product. They don't realize there's variable rate mortgages that, yes, they would qualify for, because there's no different qualifying standard for a variable versus a fixed. There used to be, but there isn't anymore. They don't realize there's 1-year terms, 3-year terms, 2-year terms, 4-year terms. You can tailor things. A lot of Canadians just fall into that 5-year fixed trap. Why? Because their parents told them so. Why did their parents tell them so? Because the banker told their parents to tell their kids so. Don't talk to your parents unless you're a mortgage broker. Don't let the marketing drive your decision. Let the help of an expert broker drive your decision. So should I keep going? Should I do the math on 5 times an interest rate hike? Or are we starting to see that even in the face of very significant interest rate spikes, we will in fact survive? Let's try and remember this. When the Bank of Canada finally bumps interest rates by 0.25%, right? The overnight rate is going to go from a 1/4 point to a 1/2 point, taking prime up a 1/4 point with it, which is only going to impact, 20% or so of mortgage holders who are in variable rate mortgages. And it's going to impact them by how much again? By $13 per month per 100,000. So yeah, the average Canadian, the new variable rate mortgage client, they might see their payment go up $50, depending on which lender they're with. The average past mortgage might go up $40, depending on. So again, we will see headlines talking about interest rates doubling. Yeah, 0.25 to 0.50, the overnight rate. But we will see all of this panic pushed into the market, into the headlines. As soon as interest rates start trickling up, just at 1/4 point, 1/2 point, it will begin. The predictions of the beginning of the end. And hopefully over these last 3 little segments, I've demonstrated that the real math shows us there will not be economic devastation in the Canadian real estate market if interest rates go to 4% or 6%. Now, yeah, 8% is a whole lot tougher to handle, and it's going to be a bigger impact. But again, it's really only the brokers on the inside of so many different mortgage applications struggling with the lack of logic, struggling with qualified borrowers who can clearly make the payments that are unable to get approved, that realize the overwhelming majority of Canadians who have re-underwritten their mortgages or taken a brand new mortgage since January 1st of 2018 in particular are in really, really good shape. They really are. I'm going to leave it at that. Thank you so much.